Hi, I'm Hafiz and I'm going to take you through some more important areas of CIMA P1. Okay, so welcome to the CIMA P1 live online session. Let's get started. Right, in the last session we started decisions under risk or uncertainty. Okay, so about 5 minutes of recap before we take it further. We discussed that uncertainty is that business condition whereby the managers make decisions for the future without relying upon the past experience, simply because in some situations past data are not much reliable. Past observations may not be sufficient, or past observations may not be consistent, which can be relied upon to make future predictions or future decisions. So in a situation of uncertainty, managers make decisions without looking at what happened in the past. For example, launching a very new product, unique product, which has never been launched in the past. So because we don't have much information, so we have to make decisions based upon whatever we believe, excuse me, or whatever the research we do about this product, but not relying upon the past. Then we discussed risk. Risk is that uncertain situation in which uncertainty can be quantified in some way. Risk is a decision-making approach when the managers make decisions by relying upon past statistics, past observations, and past data. So a number of times you might have noticed these shops, they are making these decisions under the risky conditions. For example, how many packets of juice they are going to sell today. Well, they don't know exactly, but based upon last Wednesday or last Tuesday, they can see the trends or week before, and they can buy perishable products like sandwiches or milk or meat and poultry or any vegetables which don't have very long life. So based upon past experience, we can make the decisions for the future that more or less this may occur. Then we also discussed in the previous session that this chapter is not about, this topic is not about making a right decision or wrong decision, simply because decisions depend upon risk attitudes. Okay, when the managers make decisions, they purely rely upon what they believe about risk, what they believe about past experience. Some people are more optimistic, some people are bold, and they like to make decisions by taking more risk. Simply the idea is greater the risk, but hope of making greater returns as well. Now, some managers are risk averse. They feel like that we shouldn't invest our money or our investments in somewhere which bear larger risk. So those are pessimistic or conservative decision makers who like to take low risk. Simply the idea of low risk, low returns. Then we discussed risk neutral decision makers as well in the last session, that these are those decision makers who apply middle of the road policy, neither too large risk nor too low. Okay, so somewhere like go with the flow policy is adopted by these decision makers who do not evaluate risk that much. They simply consider, if many people are doing this, I think I will be okay as well. Okay, now we are looking at some more ideas about the risk. First of all, payoff table. Payoff tables are simply pro formas or structures or formats which include summary of all possible profits or losses, whichever is the case. So payoff table is like a statement or a table or a format which includes the calculations of all possible profits or losses under all outcomes. Meaning to say is this, that if I am making a decision for tomorrow, okay, that I'm going to buy 10 bottles of drink, for example, okay, or I'm going to buy, let's suppose, some of the vegetables or fruit, etc. Now, when I'm making this decision, I will simply rely upon the past experience. So if, let's suppose, I buy 10 packets or 10 boxes or 10 bottles, okay, today, what happens if demand is exactly 10? Calculate the profit if I purchase 10 and demand was also 10. So one profit goes into the payoff table. Or what happens if I buy 10 units or 10 bottles, etc., 10 cases, 10 boxes, and the demand is less than 10? What would be possible or likely profit if I buy 10 and demand was less than 10? Less than 10 people came into the shop. Or what will be likely profit if I buy 10 units and demand was more than 10? Okay, so that's simply the calculation of profit and loss goes into the payoff table. Long as you know the meaning, simple meaning of profit and loss, which is simply revenue minus costs, then payoff table is not a difficult thing. I will show you in a few moments. Okay, so with the help of payoff table, we will apply the decisions to risk seekers, risk averse, risk neutral, etc. So payoff table becomes a basis to make decisions under risk. Okay. Here are some of the decision criteria, or we can call them decision rules or methods. Okay. First of all, we need to understand them, and then we are going to apply them with the help of a proper question. These are different decision methods which are applied by different decision makers. Okay, not all are used at the same time. So please remember, idea is every decision maker has a different attitude towards the risk. So every decision maker will be choosing one of the 4 criteria. We are going to look at them. Okay, because we all are different. If I am, for example, naturally, if I am a risk seeker, then I'm not risk averse. Okay, meaning to say, at the time of making decision, if at the time of making decision, if I'm risk averse, then I'm simply not risk seeker. So one approach is used at one time. So there is nothing right or wrong. There is no accurate or inaccurate. So if you feel like saying what's the best decision, what's the best method, there is no answer. So please remember, there is neither a best method nor a worst. Idea is every decision maker will choose based upon his risk attitude or her risk attitude. Okay, the first one is maxi-max, which is the combination of 2 words. One is maxi and second is max. It stands for maximizing the maximum returns. Maximizing the maximum returns, or some people call it best of the best. This is applied by, we will learn how to use this. This is applied by risk-seeking decision makers. Those are who are risk seeker or optimistic and bold decision makers. They use maxi-max, maximize the maximum returns. Second is maxi-min. Again, combination of 2 words, maxi and min, which stands for maximizing the minimum returns. Maximizing the minimum returns, or best of the worst case scenarios. Maximin is applied by risk-averse decision makers, those decision makers who are slightly pessimistic in their decision making or conservative approach. Let's go for the lowest risk. Okay, we will look at that as well. Mini-max regret. which is minimize the maximum regret. Minimize the maximum regret. So we will look into this. These are those decision makers who are always comparative, or they compare their decisions with other decisions. Whether I have made a better decision than the others available, or I have made worse decision than available decisions. Okay, so we will look into this, how it works. And last one is expected values. Expected values are simply the weighted average values of all outcomes. And remember, what is average? Average is simply in the middle of the road policy. Okay, because how do we calculate averages? For example, if somebody gets 70 marks in one paper and 80 marks in another paper, how do we calculate the average? 70 plus 80 divided by 2, and that lies in the middle of 70 and 80. So average is simply in the middle of the road policy, neither risk seeking nor risk averse, so somewhere halfway through. Okay, so we will look into the expected values, how to apply. Expected values are simply weighted average values of the whole outcome. Okay, it does not reflect degree of risk, but simply what the average outcome would be if the events were repeated a number of times. If consistency was there, as I was talking about, based upon past experience, if there was a consistency, then what would be average or most likely outcome? Okay, not the best, not the worst, most likely. A decision rule to select the course of action with the highest expected value. So please remember the decision rule, that when we calculate expected values, a rule is to choose the highest expected value among all. Okay, we will look at this in a moment. Here is the formula we use for the expected values, a very tiny formula. Okay, that's why it's not even given in the formula sheet of the exam paper, because it's so simple and small, which is sigma px, sum of px. Now P stands for probability of an outcome. Now what do we believe about probability? Generally, definition is probability represents chances of occurrence. Probability represents chances of occurrence. What are the chances? What will happen? Okay, what may occur. So when we flip a coin, when we toss a coin, okay, and it lands somewhere, now what do we expect when the coin is going to drop below? Well, some people expect it may be a head, and some people guess it may be a tail. Based upon their own attitude or based upon their own guess, they think it may be a head or it may be a tail. Now, why do they say it may be a head or tail? Simply because the coin has only two sides. So it may land on a head, it may land on a tail. One of the two things may occur. So based upon my observations, I have always observed that the coin was either landing on a head or either it was dropping on a tail. So one of the two possibilities. But what if I bring a special type of coin, strange type of coin, and I toss the coin and it doesn't land on a head, doesn't land on a tail either, but it stands on the edges? It may be, then it means there will be a third probability as well. But hold on a moment, I never observed this in my life. So what I believe about probability is nothing but my observations. Whatever I have observed gives me an idea this may occur in the future. Same thing when you roll a dice, and one of the 6 possibilities may arise, either 1, number 2, number 3, 4, 5 or 6, because this is what we have observed. We never seen that the dice is standing somewhere between the two numbers. It's always one whole number. Okay, so 1/6 possibilities. So that's how we consider the probability. It is simply based upon past observations. Past observations, and X is the value of outcome. Okay, P is probability and X is value of the outcome. When we say value, we simply mean to say it's the monetary value. It's the monetary value, okay, monetary value of the outcome, which is simply in form of sales, in form of costs, or a profit or loss when we subtract cost from the sales. Okay, mostly in your syllabus, most of the time in the questions, it is either a profit or a loss, mostly profit or loss. So sigma px, P is probability, X is the value of the outcome, and this little chappy here which is sigma sign, it is simply adding everything together, taking sum total, summation. Okay, we will see how to apply this. Let's move on. I will explain value of perfect information little bit later on, okay, in this session, but once we have done something else, and then you will better understand what value of perfect information is. Okay, here we go. Question number 25 for your consideration, okay, which is on page number 81. Page number 81. Okay, so please get your notes sorted out. Here are some of the requirements. Okay, right, page number 81. So I suppose we all have it. Let's do it. Product home is a highly perishable commodity that can be sold on the retail market for $20 per case. So the selling price of this product is $20 per case, or as scrap at $1 per case. Okay, meaning if it gets sold during the normal business hours, we sell it for $20. But if it cannot be sold during the normal business hours, then it may reach expiry date, because it could be a highly perishable commodity, means, you know, it may not have much life. For example, we know milk, okay, dairy products do not have much longer life. Okay, meat and poultry, or any fruits and vegetables, okay, we know these do not have very long life. I'm talking about fresh commodities, and normally most of the people sell it same day. And if nothing is sold, if something is not sold, it can be sold as a scrap for a smaller price. Tom costs $10 per case from the wholesale market and is only suitable for sale at the retail market for up to 24 hours after purchase, meaning one day we have to sell it, next day we need to buy again. Okay, so that's the idea. If it can be sold during the normal time, working hours, it gets full price, $20. But if we don't sell it on the same day, maybe right at the end of the late evenings, we have to sell it as a scrap for $1. So did you notice some risks and hopes? Okay, I will solve this question. First of all, let's understand everything. Did you observe some risks and hopes? Well, the cost of the Tom is $10. So if it can be sold during the normal day, we make a profit of $10. 20 minus 10 is $10. But if it cannot be sold at the normal price, then it will be sold at $1. And if the cost of purchasing is 10 and we are selling as a scrap for 1, it means there is a loss risk of losing $9. So on one side there is a hope of making $10 profit. On the other side there is a risk of losing $9 as well, if due to any adverse weather conditions or due to any other reasons, competition or so on, people don't buy it, then there is a risk of losing $9 per unit. Okay, Amanda, a market stall owner, has kept the following records of sales of the Tom over the past 50 days. So Amanda, who's the business owner, she has kept records of sales over last 50 days, meaning last 50 observations or past 50 statistics have been recorded by Amanda. And what are these past statistics? That over 15 number of days, daily sales were 10. Over 25 number of days, daily sales were 20. And on 10 days out of 50, she sold 30 cases. Okay. Now we are not given any probabilities here, but we are given a clue how to calculate probabilities. Remember what I said, probability simply represents past observations or likelihood from the past observations for the future. So idea is simply this. How do we calculate it? It's very simple. There are total number of observations which are 50. 15 out of 50 observations, that simply constitutes a probability. So individual observation divided by the total observations, we get a simple value of probability. It can be written as decimal points or it can be written as a percentage, 0.3 or 30%. Then 25 over 50, which is 0.5 or 50%. And lastly 10 over 50, which is 0.2 I guess, or 20%. And if we add them together, we get 1 or 100%, because maximum is 100%. So what we are saying now here is there is a 30% chance that the daily sales will be 10 units tomorrow. There is a 50% chance that sales may be 20 tomorrow, or there is a 20% chance that demand may be 30 cases tomorrow. Nobody has seen the future, so we don't know. I mean, at least I haven't seen the future. Okay, I don't have the time machine, to be honest. So whatever we may see in future, time will decide whether the actual demand is 10 or actual demand is 20 and actual demand is 30. So what we are looking at is based upon past observations that may likely occur. Once we have derived the probabilities using this simple method, now we are looking at the requirements. Requirement A. Prepare a summary that shows the forecast daily profit earned by Amanda for each possible outcome. So prepare a summary, and that summary is simply payoff table. Payoff table. Okay, so let's prepare payoff table by taking into account all possibilities. Question 25. Okay, here is the requirement A. Payoff table. Okay, now it can be constructed in so many ways. Okay, just like, you know, financial statements can be presented this way or that way, whichever way, so many methods. Okay, you don't need to follow this one, but I find it very useful and many candidates find it quite comfortable to follow this. Okay, which is this. On the left hand side we write down any possible outcomes, meaning what may occur tomorrow, what may happen tomorrow. In this question, it is about demand. Okay, daily sales or demand, that what may be possible demand tomorrow. Well, we are given demand can either be 10 cases or 20 cases or 30 cases. Okay, we don't put these or in this payoff table, but this is exactly we mean by that we can't have 3 demand levels tomorrow. Okay, in future, on one day demand can either be 10, or on one day demand can either be 20, or on one day demand can either be 30. So in one day demand can't be 10 and 20 and 30 at the same time. So okay, I mean, when we say today we have a good weather, it means today we don't have bad weather. As simple as that. Well, yes, sometimes it happens. In the morning it's nice and evening it's very adverse. Okay, but here we are trying to say that at one time two things can't happen at the same time. Okay, on the right hand side we write down possible decisions. Possible decisions, and in this question what are likely or possible decisions? Well, simply buying or purchases. Okay, right, let me ask you a question. We are given that on some of the days demand was 10, on some of the days demand was 20, and yet on some other days demand was 30. What do you think? If it is your business, okay, would you like to buy 10 cases for tomorrow? Would you like to buy 20 cases for tomorrow? Or would you like to buy 30 cases for tomorrow? What do you think? Right? I'm waiting for your responses. What do you think? Would you like to buy 10? Would you like to buy 20? Or would you like to buy 30 cases based upon possible demand outcomes? Oh, somebody just said 10 cases. Fine. Right? Oh, I heard somebody saying 20 cases. Okay, I agree. Somebody is saying 30 cases. Because of the risk attitudes, somebody may like to buy 10 for tomorrow. Based upon the individual risk attitude, somebody may like to buy 20 cases tomorrow. And there is nothing right, nothing wrong. It is based upon what I believe about future. So some people may like to buy 10, believing minimum demand may occur. Some people may like to buy 30, believing maximum demand may occur, a hope. And some people may apply middle of the road policy, neither buy 10 nor 30, let's buy 20, okay, and see what happens. One decision at a time will occur. If I have purchased 10, I didn't buy 30. Now this is the way we set up the payoff table. Only one decision is considered at a time. So let's try to calculate possible profits if decision was to buy 10 cases. If purchasing decision was to buy 10 cases, what are likely profits? First of all, let's compare it. That I purchased 10 cases and demand tomorrow, for example, for a minute, we don't know about future, for the minute, I purchased 10 cases and let's suppose demand is 10, exactly 10 tomorrow. In that case, what would be likely profit if I buy 10 and demand is also 10? Here is simply a profit or loss. Sales minus purchases. Okay, sales minus purchases. Well, if I have purchased 10 cases, purchase price was 10. So the cost of purchases is $100. And then if demand is also 10, I would sell these 10 cases at $20 each, and my sales revenue will be $200. Sales revenue will be $200. So 200 is the sales revenue, 100 is the cost of purchases. Okay, my likely or possible profit will be $100. Okay, you don't need to do this calculation in exams, okay, because numbers are mostly straightforward. If the numbers are mostly straightforward, simply pick up your calculator and then punch in those numbers in your calculators, and in half a minute here is the profit. Is it okay? I will tell you exactly how examiners ask about payoff table. First of all, let's learn the whole payoff table, and then I will tell you how you will be examined about this in actual exam. Okay, so first possibility was purchase 10, and if demand was also 10, our possible profit will be $100. Okay, now let's have a look at the second possibility. What if I purchased 10 and demand was 20, meaning 20 people were in the queue waiting for the product Tom? Well, I had only purchased 10 and even the demand is 20. Can I sell 20 if I only have 10 cases in front of me? I agree with you. You are telling me no. If I have only purchased 10, I can only sell 10. Even the demand is 20, and I can apologize from rest of the people, okay, that just go away. You don't need to eat Tom today. Okay, out of stock. So profit will remain the same, $100 here and $100 there. Okay, so if the demand was 10 cases, these are possible profits when the demand will be 10 or 20 or 30. Okay, now let's do the other ones. What if I didn't buy 10? What if I didn't decide to buy 10 because some of you were telling me to buy 20? What if I purchase 20? What if I have purchased 20 cases instead of 10? Let's calculate possible profits in that case. That this time we have purchased 20, and what happens, what will be profit if demand tomorrow is 10? Again the same situation, we have purchased 20 and demand, for example, was 10. And let's calculate the possible profit just like before. Here is the sales minus purchases, or sales minus costs. So they purchased 20 cases for 10 each. So the cost of purchases is $200. Now we are selling them. 10 cases will be sold because demand is, remember, demand is 10. For example, demand is 10. Then first 10 cases will be sold at normal selling price of 20. And what will happen with the remaining ones? Because we remember we purchased 20 cases and 10 were sold during the normal business hours. And at the end of the day, there was an inventory of 10 cases left with the business. And now those 10 cases are sold as scrap. Scrap price of $1. And that's the total sales revenue, which is $210. 210. So 210 minus 200, a likely or expected profit of 10 may be earned on that day when we purchased 20 and demand was only 10. Okay, so we calculated another possible profit, which I can write here. And in this way we build the payoff table. Now here is the next combination. That if 20 cases were purchased and, for example, demand was also 20, all possibilities, we purchased 20 and demand was also 20. In that case, I suppose you are telling me profit will be 200 simply because we purchased 20 at $10 and we sold 20 at $20, and the profit will be 200, and same 200 applies here as well. Okay, and job done. Second possibility has been discussed. Now we are looking at the third possibility, that for example we neither purchased 10 nor 20. What if some risk seeking decision makers went to buy 30 cases? In that case, let's see what would be possible profit or loss. Okay, let's do all combinations again. That decision was to purchase 30 cases. Okay, we have purchased 30. Let's see what if the demand tomorrow is 10. What will be likely profit or loss? Okay, so here we go. This time purchases are 30 and demand is only 10. First possibility. So here is the difference between sales and purchases. Sales minus purchases. First of all, we will buy 30 cases at $10 each, and that gives us the cost of purchases of $300. Cost of purchases of $300. Now we are selling them. Now the first possibility is if demand is only 10. So 10 cases will be sold at normal selling price of 20 when they were fresh, and then the remaining near expiry 20 cases will go away as a scrap value of $1, and the total sales are $220, and in that case there is a likelihood of making a loss of $80. Okay, and that goes into the payoff table here. Okay, now you need to calculate the next possibility. If purchases were 30 cases and let's suppose demand was 20. Okay, so here is again sales minus purchases. And actually you should not be watching this now here. You need to spend half a minute. You can pause it, okay, and you should try to calculate this yourself. Okay, that if we have purchased 30 cases but demand was only 10, what will be profit? Second possibility, if we purchased 30 cases and demand was 20, okay, what would be likely profit? So each possibility you need to explore. Okay, so here is 20 cases will be sold at normal price of 20, whereas the remaining 10 cases which will be left unsold inventory will be sold off as a scrap price of 1. Okay, and here are the possible profits or losses. So it's 410 sales minus 300 cost of purchases and likely profit of $110. Okay, that goes in there. And third case scenario, if somebody buys 30 and for example it was a winning day, lucky day, demand turns out to be 30 as well. So all 30 units will be sold at the normal price, making a profit of $10 from one case, and for 30 cases it will be $300. This is what we call as payoff table. This is what we call as payoff table. Now here is what I can tell you what examiner will ask. They will not ask you to define the whole payoff table, but you need to understand how it is done. We look at one decision at a time and one outcome at a time. Then the same decision and second possibility. Then the same decision, third possibility. Okay, likewise, here is the decision and first possibilities, decision and the second possibility, and the decision and the third possibility, and same principle applies to the 30 cases as well. Okay, one by one. So if there are 3 possible decisions to make or choose from, and there are 3 possible demand levels or possible outcomes to occur, 3 times 3 is 9 possible profits we need to develop. Okay, now understanding is this: examiner may only ask you to calculate 1 or 2 maximum profits, okay, 1 or 2 profits the most, simply because we can't do this whole thing for one question. It's too longer for a shorter question. Okay, they may ask you what was the profit here. Okay, they may hide it and ask you what will be the profit here, or they may ask you what will be the profit there. So they will give you maybe a number of profit values, and they may omit, they may hide 1 or 2 possible profits or losses maybe, and then you have to look at what is the decision, what is the outcome, revenue minus cost is likely profit. Is it okay? So this is how we define the payoff tables. Now we are looking at the risk attitudes. Which is the requirement B. Advise Amanda how many cases to buy if she uses. There are few methods here. Okay, number 1 is max. Okay, buying the maximum units, but I will justify how it works. Advise Amanda how many cases to buy if she uses max, if she is a risk seeker. Advise Amanda what if he uses maximin, being risk averse. And advise Amanda based upon expected value, and advise her if he uses minimax regret. Not all at the same time. So we will do one by one. Let's apply the maximax. Okay, so same payoff table I'm using here. Okay, here is the maximax. Now it stands for 2 things: maximax, maximize the maximum returns. Okay, or remember it in this way: first M is maxi and second M is max. Okay, maximize the maximum returns or best of the best. Now in exams it has to work very quick, meaning literally in half a minute, 1 minute we should get it out of the way. Now this is how we work it out in exams very quickly. If you read it the other way around, that's exactly this method works. That's how exactly this method works, okay, for risk-seeking decision makers, maxi and max. But first of all, we look at max part and then we look at the maxi part. So please remember it works the other way around, okay. First of all, let's select the max part. Look at all 3 profits under the first column and simply pick maximum profit. Now because there are 3 profits, 100, 100, 100, so you can pick any of the 100. Okay, then look at the second column. Then again you have 3 profits and our aim is to choose the best profit among them, or maximum profit, which you can choose any of the 200. Okay, and same thing, third case scenario. Sorry, here this was a loss in brackets. Now there are 3 scenarios: either there is a loss of 80 or a profit of 110 or a profit of 300, and again we are going to go for the maximum profit, which is 300. It doesn't even take more than 10 seconds to pick these maximum. Okay, once you have picked those up, now our aim is maximize these maximum profits. Now here is this maxi part, that there are 3 possible profits, 3 maximum profits, 100, 200 and 300, and which is the best among them is that 300. and 300 is under 30 cases. So I knew this already, but that's how we justify in exams. Okay, 30 cases to buy. If decision maker is risk seeker, then he or she should buy 30 cases. Okay, we don't know Amanda whether she is risk seeker or risk averse. Everybody is different. Okay, now we are looking at the maxi-min, which is requirement 2. Okay, again there are two M's, maxi and min. Maximize the minimum returns, and it also works the other way around. First of all, we look at the min part and then we look at the maxi part. Okay, exactly the same idea. Please look at each column, each decision, and from each decision, first of all, pick the minimum profits, which I can pick any of the 100. Here is 10, and here is a loss of 80. These are now minimum profits under every decision. And from the minimum profits, our aim is to choose the maxi or maximum, which is best of the worst case scenarios. There are 3 possible lowest profits, and our aim should be choose or go for the best of them, which is this 100, and 100 lies under 10 cases. So if Amanda is risk averse decision maker, she may choose to buy only 10 cases rather than 30. Okay, that's how it works literally in 20-30 seconds in exams. Okay, now let's have a look at the next requirement, expected value. Okay, so here we go. Expected value, which is simply this formula sigma px. Is it okay? Let's look at that. But before I look into this formula and calculations and then decision, I need to copy and paste the payoff table. I just don't want to go back into the previous numbers. Okay, so here is, please allow me, I can copy and paste literally in 1 minute. Okay, and the profits were 100 excuse me, 100, 100, 10, 200, just need to double check, 10, 200 and 200, and here was a loss of 80, and then it was 110 I guess, and 300. Okay, now once I have the profits, okay, now payoff table is there, right? So you can make better sense of this. Now we are looking at the sum of px. Okay, remember we have already calculated probabilities from the question, which was 0.3 here, 0.5 there, and 0.2. Okay, I can take you back into the question page 81, and you can see actually we had derived the probabilities already. For 10 cases it was 0.3, for 20 cases it was 0.5, and for 30 cases it was 0.2. Okay, let's have a look. 0.3, 0.5 and 0.2 multiplied by x, these are x values or profits, we will simply get P times x. So 0.3 into 100 is 30, 0.5 into 100 is 50, and 0.2 into 100 is 20. And if we add them together, we simply get a sum total of 100, I guess. And isn't it the way we defined probability, isn't it the way we defined expected value as the average, weighted average value of the outcomes? So if there are three figures, 100, 100, 100, what would be the average of three 100s? Well, it will be still the same 100, okay? Now here is the second possibility. 0.3, same probabilities multiplied by 10, multiplied by 200, multiplied by 200. So 0.3 times 10 is 3, 0.5 into 200 is 100, and 0.2 into 200, that comes to 40. And the sum total sigma px is 143. Is that okay? Exactly so, all probabilities times by the outcomes. So 0.3 into minus 80, we get 24, I guess, but keep in mind it's negative. 0.5 into 110 is 55, and 0.2 into 300 is 60. So now there is one negative value there as well, so you got to be a little bit careful, okay? 60 plus 55 minus 24, which comes to 91, which is the sum total. Now we have ended up with three expected values, 100, 143 and 91. And remember, the decision rule is to choose the highest expected value. Choose the highest expected value, which is $143. And on this basis, Amanda may go for buying 20 cases. Neither to buy 10 or to buy 30. If she is a risk neutral decision maker, she may choose to buy 20 cases. Okay. Fourth one is on page number 81, mini max regret. So mini, then max, then regret, okay, which is three things: minimize the maximum regret, minimize the maximum regret. And again, it works the other way around, as we seen in maximax and maximin. Okay, first of all, we find out regret, then we look at maximum regret, and then the aim is to minimize these maximum regrets. Okay, so first of all, please allow me to copy and paste payoff table very quickly, okay, which is 100, 100 and 100. Okay, then here it was 10, 200 and 200, and then we had a loss of 80, 110 and 300, and here it was 10 cases, 20 cases, and 30 cases. Okay, I just copied and pasted the same original payoff table so I can understand it very well, and you can also get the right meaning. Okay. First of all, let's calculate regret. But before I calculate the regret, let's go a little bit deeper into this. What do we actually mean by regret? The meaning of regret is just like feeling of loss, or some people call it opportunity cost. Some people define it as opportunity cost. Okay, again, whichever way you need to define it, what it is actually. So please answer me. What if somebody tells Amanda, for example, okay, just keep listening to me. For example, let's say somebody tells Amanda that demand may be 10 cases tomorrow. For some reason, somebody knows that demand may be very, very strong chances demand will be 10 cases tomorrow. If demand will be 10 cases tomorrow, how many cases Amanda should purchase today? How many cases she should decide to purchase if demand will be 10? Well, I think you are right that if demand is 10 cases tomorrow, best decision is to buy 10 so that she can buy 10, sells 10 and no regret. But what if she doesn't listen to us? Instead of buying 10 cases, she decides to buy 20, then she will go home with a profit of $10 only. And that's where the regret or feeling of loss comes. That, oh, I wish I had made a better decision and I would have gone home with a profit of $100 rather than a profit of $10 only. And she would feel, I lost $90 as a result of choosing a wrong option. I made less profit as a result of making a wrong decision. I should have made a better decision. So whatever the feeling of loss would occur to us, that feeling of loss is called as opportunity cost or regret. So it is simply a value of loss or feeling of loss for not making a right decision. Okay. Now this was the understanding. Now how do we calculate very quickly in exams? Literally it takes 30 seconds to develop regrets. Okay, so here is the first value of regrets and you would notice how quickly it takes if you follow the method. Other methods are there as well. This is the quickest one. Look at each line or each row, okay, that if demand is 10, what are likely profits? 10, which is 100, 10 and minus 80. And from these three profits or losses, pick up the best one. Well, best one is 100 and that's where there is no regret. That's where there is no regret if she makes this decision. Then here are the other regrets. Once you have chosen the maximum profit of one line and put down 0 underneath, now what you need to do is from this maximum value minus the smaller value. So 100 minus 10 is $90. Okay, and then 100 minus 80, when there are two things, negative signs, here is 100 minus and then 80 is also minus, and it ends up with a positive 180 of not making a right decision. Okay, here is the second one. If demand is 20 cases, in that way, here there is no regret. And 200 minus 110 is a regret of 90 and 200 minus 100 regret of 100. That's how we quickly define regrets. Same principle let's apply to the third possibility. If demand is 30, then here is no regret, and 300 minus 200 is regret of 100, and then 300 minus 100 regret of 200. Okay, regret of not making the right decision. Regrets are done. Literally 30 seconds comparing, okay, and taking the difference. Once we have calculated the regrets, then we are looking at the second part, which is max. So here are the maximum regrets. Okay, please look at each decision. Okay, from the first decision, only look at the red numbers, which are regrets: 0, 100 and 200. Maximum is 200. Then look at the second decision: 90, 0 and 100, and maximum of the three is 100. And then so on. Look at the third decision and look at maximum regret, which is 180. So we developed regrets. Now we picked up maximum regrets, and picking this up takes only 10-20 seconds. Okay, now I'm looking at the last one, which is minimize the maximum regret. So this mini part is there. And which one is mini? There are three maximum regrets: 200, 100 and 180, and minimum or lowest feeling of loss is $100, and that comes to when somebody buys 20 cases. Because this occurs under the 20 cases. If somebody buys 20 cases, whether she makes more money or less money, at least she will have lowest feeling of regret, that I didn't lose that much by not making a right decision. Okay, so these were 4 decision methods. Okay, examiner will not ask you to develop the whole mini-max regret, to be honest. Okay, simply because marks are very little in exams, short questions. Examiner may give you all regrets, and they ask you to apply this mini-max regret. Okay, or examiner may give you few values of regrets, and 1 or 2 regrets they ask you to calculate, just like this minus that. Maximum profit minus minimum profit is a regret. Okay, once we calculated this, now we are looking at the part C of the question. Okay, a research consultancy firm has approached Amanda to provide a more reliable estimate of her future demand. Remember before how Amanda was deciding that we were using the risk attitudes, that if Amanda was risk neutral, how many cases she should buy. If Amanda was risk seeker, how many cases should she buy. If Amanda was risk averse, how many cases to buy, etc. Okay, or if she uses mini-max regret, how many units to purchase. So that was purely based upon the risk attitudes. There was no scientific reasoning behind it. If I was risk seeker, I was going for 30. If I was risk averse, I was going 10. And if somebody asks me, prove why are you thinking this way, I have no justification. It is simply in my head what I believe about risk. What I believe about risk. Okay, my observations and my attitude towards risk, my preference towards risk. Now Amanda has been approached by a research company, research firm, and these firms are those companies which collect the market data. They do the market research, collect the market data, then process this market data, okay, and then the results of this market research are sold over to many companies. Okay, that our market research indicates what will be likely demand on a Friday. Our market research shows what will be expected demand on a Thursday, Tuesday, Monday or Sunday, whichever days. They will give us a kind of a spreadsheet. Okay, that based upon our research, on Monday maybe 10 customers will turn up. On Wednesday, how many they will tell us. Okay, this market research firm. Now, being an accountant, actually, I don't know whether the perfect information exists or not, but I have noticed, because I'm not the market research expert, okay, it's different people who are collecting this information from the market. You might have seen them, you might have spotted them, or at least some of you might have come across with them. around the airports or train stations or somewhere in the common attraction spots. You are walking somewhere near the attraction spots, and then some people come to you and they collect market research. Okay, of course, if you allow them to pass on the data. Okay, now being an accountant, I think I seen it happens, but it's not my job to collect market research. My job is simply to do this part, calculate the maximum price Amanda should pay to gain this perfect information. Okay, and this is what I was talking about before. I will explain value of perfect information. Value of perfect information is simply the price that one would be willing to pay in order to gain access to perfect information of an uncertain outcome in decision making. Okay, and that's known as value of perfect information. So when there are uncertain outcomes, either this may happen or that, a number of companies buy the market research data from other market research consultancy firms, and whatever the price they pay, this is called as value of perfect information, which is the maximum price to pay to gain market information. Okay, how it is calculated is this. Mathematically, it is calculated in this way. We compare expected value chosen before perfect information, expected value which we calculated before perfect information, with the expected value as a result of perfect information, or expected value after gaining perfect information. And this difference is called as value of perfect information. Okay, so it's the difference between expected value chosen before perfect information and expected value after gaining perfect information. Perfect information, what is it? That tell us on Monday how many customers will come. Tell us on Tuesday how many customers will come, so we can plan our purchases in a better way rather than relying upon our risk attitudes. Okay, now first of all, let's look into this part. Expected value which we had chosen before gaining the perfect information. So I need to take you back. Here is the expected values which I was calculating, and remember which one we had calculated. We had picked up 143, which was the highest expected value at that time. Okay, so this becomes our starting point. We had chosen 143 being highest expected value of profits or average value of profits. Okay, so when we didn't have this perfect information, expected value was $143 profits. Now let's have a look at what will happen if the expected value changes. Okay, so here is the perfect information I'm developing here, that this research company will tell them to buy 10 cases because they know somehow demand will be 10. On certain days, they will tell them to buy 20 cases because on those days they expect 20 people to turn up. And for some of the days, they will advise them to buy 30 cases because remember, over the past 50 days, on some of the days 10 people were coming, on some of the days 20, and on some of the days 30 people were coming. So at the moment we don't know on which day 10 people will come, on which day 20. So this market research company will collect information and they will advise us, buy in this plan and you will be better off. Different days and different demand levels. Perfect information is simply this, that we will buy 10 we will sell all 10, and we will make a profit of $100. Is it okay? Perfect information is we will buy 20, we will sell 20, and we will make maximum profit on that day of $200. And perfect information is we will be told to buy 30 cases on a day, we will buy 30, we will sell all 30, and expected profit will be maximum $300. Okay, but not every day we will be buying 30, and not every day we will be buying 10 on some of the days. And that's where this weighted average comes, that on 30% of the days we will be buying 10 cases, on 50% of the days we will be buying 20, and on 20% of the days we will be buying 30. So this is P multiplied by X. Okay, so it's XP or PX. It is P multiplied by X, and we get here P times X as 30, 160, and when we take the sum total, it becomes sigma Px, which becomes 190, I suppose. Okay, 190, and this becomes expected value after gaining the perfect or reliable information, 190. Now the difference between 143 and 190 which is $47. This is called as value of perfect information, that after gaining this reliable information, expected value of profits increased, and that's called as value of perfect information per day. But please remember, it is the maximum price to pay. So as a result of this information, if her expected profits are increasing by $47 per day, she may not pay full $47. It is the maximum. She knows how much more I can't afford to pay. So she may negotiate with the research firm to pay $30 per day, $35 per day, $40 per day, but she can't pay more than $47. And so remember this, please. It is less than or equals to 47, up to $47 per day. Okay, so this was about value of perfect information. So we have learned the payoff tables, we have learned the decision methods, maximax, maximin, expected value, minimax, regret. We have learned what is the meaning of probability analysis, okay, how to derive those, and then we have just calculated value of perfect information. Okay, now here, because the time of the session is still there, we can look at the next area, which is decision tree and multiple stage decision problems, multi-stage decision problems. Okay, now understanding of the decision tree is this. Decision tree is a diagram. Decision tree is a diagram which represents multiple decisions at the same time and multiple outcomes to occur at the same time. So it's a diagram analysis which tries to solve situations by representing a very suitable diagram. Okay, so complex decisions can be simplified with the help of decision tree diagrams. Okay, that I am standing in here and thinking about, should I do this or should I make that decision? So two decisions at the same time. There can be three at the same time. Either I should invest in product A or product B or product C, and let's see what happens if we invest in A, let's see what happens if we invest in B, and let's see what happens if we invest in C, product C. Okay, so multiple decisions under consideration and multiple outcomes to occur, like weather effect or any demand and supply situations, any local laws. What if the government increases the sales tax rate? What may happen? If the government decreases the sales tax rate, what happens? What if the inflation goes up? What are the expected outcomes? What if inflation goes down? What are expected outcomes? So it's all about multiple outcomes. Okay, now this diagram has some symbols which we use. First one is that you can see, oh yes, it is a square. The squares represent decision points. Decision point means I am standing in here and thinking, should I go this way or should I go that way? What may happen if I go this way? And what happens if I go that way? So standing here, I'm actually standing on the square. Square is the decision. And circles represent the outcomes, okay, which are, if I go this way, circle, what may happen? If I go that way, circle, what may happen? Generally, these are standardized symbols, but in different books, I've seen other symbols as well. For example, I've seen triangles as well. So to be honest, for me, it doesn't really make much difference whether it is a square for the decision point, okay, or it's a horse, okay, if we can draw a horsey, that I'm standing in here and should I go this way or should I go that way? So it's just like standardization. Decisions are represented with a square and circles are representing the outcomes. Then these are connected with straight lines which are called as the connectors, okay, right? So in diagram you will see square and circles will be connected with each other. Now it's a three-step process and we are going to learn all of them. Step number one is draw and label the tree. Draw and label the tree. Number two is use expected value method to evaluate or calculate expected value of all outcomes, and we have learned what's the expected value, which I suppose, because we've done it in this session, sigma px, and then reach a conclusion. And conclusion, remember when we use expected values, how do we reach the conclusion? Simply choose a decision with higher expected value. So any decision which gives you higher expected value must be chosen. Okay, so we understood this. Now let's do little practice. Here is the question number 26. Decision tree analysis. A local council is planning to organize a charity event to support better literacy program in town. To encourage large public participation, it is thinking whether or not to advertise the charity event. Square. They are thinking, should they advertise the charity event or should they not advertise the charity event? Okay. Following are the probabilities of future outcomes. First of all, weather. 30% chances that weather will be good and 70% chances weather may be bad. Okay, because they are organizing the charity event. Okay, so of course it may depend upon the weather. Okay, that if weather is good, maybe more people participate. And if the weather is not good, maybe less people participate. And the cost of advertising here is $10,000. Possible advertising effects on the event. Okay, that if they advertise, what kind of possible effects may arise? Positive effect in good weather, 40%. when the increased participation to 4,000, and positive effect in bad weather, which is 25%, then the participation will increase to 3,000. Forecast surpluses and deficit based upon participants are as follows. Okay. I'm looking at the time. We will finish it off in the next session because it will take a little more time. Okay, so I will wind this up right here and we will take it further into the next session simply because we have slightly less time to squeeze it into this session. Okay, right, so thank you so very much for your time and patience, and I will see you in the next session shortly with decision tree and something else. Okay, right, so take care, all the very best, goodbye.